I'm gonna give you another secret that they just don't want you to know. Forex doesn't have to be that complicated. I'm making it easy for you. Let's roll that intro.
Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. When you trade and get paid, 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 oh yeah, trade and get paid.
What's going on, guys? Joe here, and it is time to trade and get paid. I got a video today that is gonna make easy trades for beginners, intermediate, advanced, doesn't matter who you are. You're gonna be able to take what I teach you today and find easy ways to enter trades that are gonna give you high reward, low risk opportunities. No further ado, let's get into it. You see here that we have a push down, all right? This is clear here. You got a nice push down, and you see I got these boxes marked out. Let me explain them. So first things first, you get a nice push down, and then you see these consolidations. They happen all the time in the market. And let me explain something to you. Not everything is a consolidation. Most people are being told that the market, when it's moving sideways, is consolidation. The truth is that there's a difference between ranging and consolidation. Let me show you. A ranging market has even highs and even lows, and it's moving in a sideways manner like this. That is how a market ranges. It is just sideways movement with no definitive direction. However, when a market is ranging, it is also moving sideways. But typically at the end, you start to see where price moves much smaller. And so you have price moving down on the top and up on the bottom. That is a consolidation, okay? Sometimes it plays out as a pattern, whether it be a triangle pattern or a pennant. That happens sometimes. But what I'm trying to help you understand is that there's a difference between the two. A ranging market shows that there's indecision and no control. A consolidating market means that there is actually a controlling factor, and what we have to do is we're seeing it push down like a spring. Imagine a spring kind of coming down and being squeezed real tight, and when it's let go, it boom, it explodes, right? And it goes far. That's what a consolidating market does. It's being pinched down so tight that when the breakout occurs, you're gonna get a really nice breakout, okay? Because those small moves are preparation for the next big move. Ranges don't do that, consolidations do. There's your pro tip for today. We see the nice push down, and it's followed by a consolidation. We see that there. Now, once we see that consolidation, here's what we're gonna do. We're gonna grab our box. Now, some of you may not like to use boxes, so you use lines. That's okay. You're gonna go down to the bottom and see where your bottom was, where your rejection was, and then you're gonna go to the top, and it's gonna be where your first structure is. There is your range or your consolidation. It doesn't matter. You can trade this on either one, but we like consolidations better. So when we see that strong push down and then the consolidation happens here, what we're saying is at this level, we know that the market is getting ready for a move, and we're simply looking for a volume breakout, not just a breakout, a volume breakout. So you see that price moves back and forth. There's no volume in the market. You get volume down with a rejection and then an engulfing candle to the upside. That is where you can take the entry. Now, I want to show you something here. This is very important for us to understand, right? We can come back up here to structure, boom, right there, and we have a really nice trade setup. We have a really nice 2.31 risk to reward. You're risking 1 for every 2.31 units of currency. That is a very good risk to reward. Now, let's be clear. Notice here that there is a big, strong volume push down, and when we have the push to the upside, it's very slow. You'll see, let me move this out of the way for you. You'll notice that it moves without any, real strong push. Why is that? Well, it's because you have a strong push down and you're trading against volume. You're trading against the direction. position. So can you do it and will the trade win? Yes. Is that the best setup? You know, maybe not. You maybe want to trade with the momentum of the trend, right? And so you have a downtrend and you're trading against it. That's okay. I don't believe you have to trade with the trend, but just understand that if you are getting into a counter trend trade, to be careful that you don't try to hold it too long before that next wave of volume comes back in. Make sure that you're using good risk management and watching so that you're not in a trade when volume goes against you. So yes, you can take the trade, but be very careful. Now, watch this. Price moves up. We call this a drop base rally, okay? Drop base rally. When you see these bases here, or these consolidation ranges, whatever, when you see these are called bases. And so when we get that, we're looking for drop base rally. This is really just a supply and demand strategy. So now watch this. Drop base rally, and what was the rally from the previous move becomes the first move on the next one. So now you say, what do I mean? Drop base rally. Right? Really nice, very easy. But now that same rally becomes rally, base, drop. So what is happening here? We're just getting continuation. That's it. Downtrend, uptrend, downtrend. That's it. High, low, lower high, lower low. That's it. That's all we have there. There's nothing. It doesn't have to be complicated, guys. We don't have to overcomplicate Forex. We can just look at market structure and see where the volume enters the market. So in this case, we have a high, we have a low, we have a lower high, and we have a lower low. That's it. The only difference is that when we get these structure points, we're getting bases. And when we see that happen, we like that because it's giving us ample opportunity to wait for the right entry when we get into a trade. We like base patterns. Just don't overcomplicate it. So rally, base, drop. Let's take a look. We get the rally to the upside. We mark our top. We mark our bottom, just like we did on the first one. Price moves within. We see the consolidation happen. There's the consolidation. And we want a volume breakout. We see that a little bit of volume comes into the market here. We get a rejection on the downside, pushes up, and then here's the big volume right there, right here. Watch this. So when that happens, what are we gonna do? We're gonna go ahead and grab our tool. We're gonna see that we have an engulfing candle that comes down and breaks past our structure. So we're gonna do the same thing we did before. We're gonna put our stop behind our structure and we're gonna come down to market structure, okay? You go back, you can find market structure. There's your trade, and look, you are 3.67 risk to reward. You are literally risking 19 pips to get 70 pips. That's perfect, beautiful. We love a 1 to 3.67 risk to reward. And in this particular case, it is all volume. Notice how on the upside trade, it kind of walked up the stairs, but it dropped down the elevator. Why is that? Because the directional volume was already in the market. We knew we were in a downtrend, so when we get a downtrend break, we already know that the volume is in our favor. So we just wait, we get this engulfing candle, and boom, volume carries us all the way down for a beautiful 70 pip win. So we have discussed, and this is all just on one chart right here, we have discussed a drop base rally. We have discussed a rally base drop. The same way that the rally from the first pattern became the first part of the second pattern, well, guess what? The drop from this pattern becomes the first move on the next pattern. So this one is called a drop base drop, okay? So this is a continuation and a reaccumulation of supply. So we have a push down, we have a reaccumulation, and then another push down. That's it. We just have drop, base, drop. We do the same thing. Price comes down here, we see structure, there we have our base. We wait for price to give us a volume breakout. We get boom right here. We get a really nice volume breakout right there. Let's take a look. We come in here, we get our tool, come back here, we put it behind structure, and there we go again. Now, this risk reward is not quite as awesome as a 3.67, but a 1.5 is still okay if that's your trading style. Now, some of us that are more conservative would put our stop loss there. Some of us that are a little bit more aggressive would take our stop loss in a little tighter behind the more immediate structure of the breakout, and you would get a better risk to reward, but it's a little bit riskier because you're got a tighter stop. So be careful on having too tight of a stop, but also make sure that you don't have too much of a stop when unnecessary. theory. You want to make sure that your risk reward is in good favor. And if a risk reward is ever out of your favor, you're risking more than your reward is, then just don't take the trade. So in this case, let's talk about the aggressive people. We come in here with a tight stop. We're risking 23. We get 48, 47 and a half. We're very happy with this trade. We're really good. We get a nice volume breakout, and really we just got a drop base drop. So we just get another continuation off of the continual pressure that the bears have in the market. Now, watch this. This is where things get very interesting. The drop on the second one, base, and another drop. So we have another drop base drop. But here's the thing, this is getting interesting here. Pay attention. You get the move to the downside, strong volume, you get your base, you can see where it goes sideways, lack of volume, small candles, bigger wicks, we get that sideways movement, and then we get a volume breakout. Now, watch this. In this particular trade, if you took the breakout right there, you could go here, put your stop behind structure, you can come down there, and you have a nice trade for your entry, but you're a 1.42. Now, a 1.42 isn't horrible. It's not the worst trade you could take, but to me, I like a 1.2 or at least close to it. I'm really not a big fan of a 1.1 or like a 1-to-1 trade. I'm not gonna risk $10 for $10, but I'll risk $10 for $20. That's a better setup. So in this particular trade, you're risking 26 to get 37. I'm personally not a big fan of that trade. Now, here's what's interesting about this. When you start to see trades that look like this, basically where price comes out and the risk is just bigger, and in other words, what you're seeing is you're running out of volume. Look at this move. Watch this. Just take a pip counter. Look at this one. 124.8, 125 pips. Let's look at the second one from top to bottom. 100.9, so 101 pips. Let's look at the third one. 84 pips. You see the increments are coming down by 15 to 20 pips each time? Well, watch this. Look at this last one. To the bottom, 64 pips, 64 pip range. You see that the increment of movement is dropping with every time price moves down. What that is telling you is that price over time is exhausting. The first move, 125 big pips. The second one, 101 big pips. The third one, 85 good pips. The last one, you get 65, but I mean, look at inside of there. You're starting to get some pretty big black candles. You're starting to get some bullish candles in there that are bigger than your bearish candles. What that is telling us is this is starting to exhaust and it's going to be over soon. You might as well just stop looking for these sell trades until another cycle happens. All right, that's a whole nother video for another time, and where I teach currency cycling, and you can watch my video above where I talked about the basics of currency cycling. But the truth is, I need you to stop right here for just a second, because I have full courses on currency cycling and how to understand wave theory and how to understand multiple time frame analysis to get perfect entries in the market every time. I mean, we're killing it. To get those courses and the trade setups and all this stuff, you gotta come over to TGP. Right now, I mean, time is running short. It's about to run out, but you can still take advantage of the 60% off. Go to tradinggetpaid.com and use the code TGP6060K at checkout and get 60% off. It means your first month only costs 30 bucks. 30 bucks for all the value we're giving. You can't beat it. Let's get back to these charts. When you start to see volume go in the other direction, it's time that the price is about to cycle. So now, here's what's interesting about that. We're looking at a 30-minute chart. Look at what the 4-hour looks like. Right? You see these are the bases we just looked at. You see that? Let me make it a little bit bigger for you. You see these bases that we just looked at right here? 1, 2, 3, 4 bases that we just talked about. Well, now, do you notice something? The 30-minute gave us drop, base, rally, rally, base, drop, drop, base, drop, drop, base, drop, and now look at all these wicks. Look at all these wicks. Now we're starting to see exhaustion. But on the 4-hour, look what we see. Drop, base, and now we're starting to see rally. Why are we seeing that? Why is that so important? Guys, let me wreck your brain here for a minute. It's not that complicated. Look at the top. 1, down to the bottom, right? Come all the way down to the bottom. You got your trend right here. You got this push right here. Look what's happening right here. Well, my goodness, wouldn't you know it? There is a golden zone on the 4-hour that needs to be tested. So just like that, what are we seeing? Drop, base, rally on the 4 hour. That rally on the 4 hour is going to base at the golden zone, and then likely it's gonna continue to the downside. Rally, base, drop. And it's gonna come back and retest this lower low. Why? Because at the end of the day, this is not complicated. If it goes back up here, rally, base, drop, what do we have? A high, a low, a lower high, and now we're going to test that lower low. Now here's what's interesting. Inside of that, we have high, low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, right? You see how this happens? This move has structure inside of it. This move is gonna have structure inside of it. This move is gonna have structure inside of it. And that's all crazy looking lines on the chart. But at the end of the day, it's not that complicated. All we're seeing here, watch this. All we're seeing here is what? Drop, base, rally, base, drop. That's it. So get ready, GBP USD, we're looking at it live chart, 4 hour chart. This week, you're gonna start to see a push toward the upside, a rally, or a base right here at this golden zone, because it's gonna have to either gather supply and make another run to the downside, or who knows, maybe it'll push on through and test this high. That could happen. We don't know that. The only thing we can do is let the waves develop in the market and ride the waves to profit, okay guys? So I want you to start looking for these base patterns everywhere, and it doesn't matter, any pair, any time frame, doesn't matter, but understand that every structure has structure inside of it. Every wave has wave inside of it. Every cycle has cycles inside of it. And when you can master that timing, you can master perfect entries in the market. Find, drop, base, rally, base, drop, base, drop. All we're seeing is structure. And every time you see these consolidations, get ready, because a nice move is coming to the market. And now that you know this, you get to make some money. Let's get it. All right, guys, there you have it. Listen, I know we talked about a lot in this video, and I got so much more to say. But for this video, I just want you to go and back test. I want you to find those drops and those rallies, and I want you to find the consolidations in between and start back testing how those volume breakouts look. Sometimes the best thing to do is wait for a retest, and really it depends on if you're a breakout or a retest trader. So I want you to look at it in the scope and the lens of your trading style, and then I'm not asking you to just trade this. I'm not asking you to get rid of everything you do. What I'm asking you to do is look at these bases in light of what you already do. If you like trading pin bars, take a pin bar at the rejection of one of these bases. If you like trading engulfing candles, take an engulfing candle breakout out of one of these bases. I'm not changing, I'm adding to your trading ability. I'm adding to your repertoire. I'm trying to enable and to empower and to equip you to become a powerful trader all on your own by adding to your skill set. So let's eat, let's win. Make sure you hit that like button, comment below and let me know what your thoughts are on these base patterns, because I want to help you. So comment below, and then make sure you're subscribing, because I have a lot of people who are watching the videos that haven't yet subscribed. Go ahead and subscribe, go back and look. I'm offering a lot of value on this channel, and I want to help you become a winning trader. Join TGP today. Go to TradingGetPaid.com, become a student, jump on board and use TGP 60K at checkout for 60% off. I'll see you in the next video.